Hi, welcome to Trade Zone for the 10th of May, 2023, sponsored by Eightcap. So let's talk about the markets as we are going to be talking about today. We are going to be doing a recap on the Aussie dollar chart that we showed on Monday, the stream on Monday, 8th of May. And then we'll talk about what's important for the rest of the week. And after that, we'll talk about just a trading tip that could be useful in your trading journey. So the recap of Aussie dollar fundamentals was that it is a surprise to the upside by to a surprise hike by the Reserve Bank of Australia of a 0.25%, a quarter of a percent hike last week, and that was not priced in by the market because market was expecting them to remain unchanged to keep their policy unchanged. But we saw a surprise hike, and in the statement last Friday, they said that they do see a need for more policy tightening, so likely more interest rate hikes in the days and in the months ahead. So, and technically, the technicals was that on the charts there was a break above psychological resistance at 67 cents, as well as on the daily Ichimoku cloud resistance, as shown by the chart I will be again displaying in a bit. That equals both fundamentals point to a stronger Aussie, technicals point to also a stronger Aussie. It equals to a bullish Aussie view on the daily time frame. So it's important to, if you use the fundamentals and technicals, I suggest, of course, using both. And then if it's both aligned, then there is a reason to be bullish or negative or bearish based on the process that you use, right? Based on the metrics that you use. So for us, fundamentally, Aussie is going to be stronger given the path of interest rates as dictated by the Reserve Bank of Australia. And on the technicals, it looks good on the charts. It's broken through resistance levels, and so that means we are bullish on the Aussie on the daily time frame. And on Monday, we showed the chart as this is the chart. Of course, it's updated as of the publishing time for the Trade Zone stream. So then we said that although it's bullish, you can see that there's a short-term resistance at around 68 cents to 68.10, right? And there's a support at 67 cents. So pretty simple charting tools that we are using. We are just using the previous spike highs on the candles in the middle of May. We just extended it horizontally across, and we see that 68 cents around there is resistance level. And what has happened since then, of course, strangely enough, on the day itself, Aussie did go higher, and it reached a high of around like 68.03, depending on the provider that you're using. And true enough, it hit the short-term resistance, and then it started to falter a bit and come off. But the fundamentals remain the same. The bigger picture remains still very positive for the Aussie on the daily time frame. But what it means is that if you are long, you should have take profit near the short-term resistance. That's how you use resistance levels for whether to get in and out of positions. And if that's the level that it got close to, should have taken off some. And that's how you use resistance. And if you're neutral, you're new to this Aussie fundamentals and technical picture, then if you want to get long, it's not to get long in the middle of nowhere close to the resistance, but rather look for a pullback to the short-term support around 67 cents. So trading is not about instantaneously clicking without checking what levels you're getting in at. It's always about getting it at levels where you have good risk reward, so such that there's a clear, if you're buying, there's a clear support to stop out of. And if you are chasing, you do not chase close to resistance levels where most of the people who are involved ahead of you are going to be reducing their position and using you as exit liquidity. So having a disciplined approach like this will help you not rush into trades that are triggered by fear of missing out, and also give you a sense of the risk reward of the trades that you're entering into. So what's important on the data calendar this week? The US front, it is the US Consumer Price Index and the US Producer Price Index. That one CPI is on Wednesday, and which is later today, and PPI is on Thursday. And on the UK front, it is the Bank of England policy meeting on Thursday. So why is the CPI, Consumer Price Index, and PPI important? Because they are measures of US inflation. It is now the primary focus of the US Federal Reserve, who is very focused on reducing inflation towards their 2% target. So inflation currently is too high relative to their target, and they are looking to enact policy measures such that it will slow down the economy and slow down inflation until inflation is headed decisively towards the 2% target. And as the Fed has told us, they are highly data dependent now. They have not committed to an interest rate hike or a pause in the next meeting. So they are very focused on inflation data as well as the jobs data, because they will continue to be hawkish, meaning they will talk tough on inflation as long as the economy remains healthy and the jobs market remains resilient. So the US CPI, the Consumer Price Index, measures a basket of goods on a year-on-year basis to show what are the price rise or reduction on a year-to-year basis. So for the March, it was 5.5% year-on-year, and later today, the data release will be for April. So they're comparing April last month's data with the month from April of last year, right? The expectations is for inflation to show prices rose at a pace of 5% year on year, and the core CPI basket, which excludes volatile components such as energy and food prices, is expected to show prices rose at a 5.5% pace, which is a touch lower than what it was in March. And it's always good to have an idea of what market expectations are and what are the likely market reaction in response to actual data coming in with respect to what was priced in. So expectations, if it comes in as expected, the dollar, the stocks, and bond yields, US bond yields, are expected to remain stable. It could fluctuate a little bit. It's not likely to have a major move in either direction. However, if it should significantly be below expectations and show that inflation is falling faster than what the market is priced for, we are likely to see the dollar fall. The dollar will fall against the major currencies. As stocks will likely rise, risk asset stocks will likely rise, commodities will rise, and bond yields will likely fall because they will be pricing for a less likelihood of more interest rate hikes going forward. And of course, if it is above expectations, then we will see the opposite reaction from the market. We're going to see dollar rise. We're going to see stocks fall because likelihood is that bond yields will rise. That is going to increase fears that the Federal Reserve will be continuing with their rate hikes going forward. So the US PPI, which is the Producer Price Index, is expected to show the basket of goods rose 2.4% year on year, which is quite a bit weaker, slower than the 2.7% in March. Of course, core PPI is 3.3%, a touch lower than what it was in March. And the reaction function would be about the same. Of course, the more important data point would be the CPI, but the reaction function will be the same. You'll see a fall in the dollar, rise in stocks. fall in bond yields. If it's below expectations and above expectations, it will be the opposite. So moving on to the UK front, the policy decision of the Bank of England is going to be shaped by data so far as well. What we have seen so far in the past month, what has been released is that inflation is quite a touch higher, quite a lot higher than what it was before and what it was expected, right? It's 10.1%, expectations is 9.8%, so remains double digits. And if you recall earlier, a few months ago, the Bank of England projected that by the middle of this year, inflation will be headed towards 4%, it will fall aggressively towards 4% from double digits. That was the expectations, but that seems to be not likely given now that we are releasing data for March, and it is going to be expected to be 10.1%. And the core inflation still too high, is 6.2% versus expected in March. It was released, so we are looking for the reaction of the Bank of England with respect to this. On the unemployment front, although unemployment did increase a bit, it is still only 3.8%. So the economy, the jobs market remain quite resilient despite interest rate hikes so far. So the likelihood would be the Bank of England will see it that way. Unemployment rate is still too low, although it's taking a touch higher. Inflation is definitely too high with respect to their target, and hence they are likely to hike interest rates by 0.25% and issue a hawkish statement indicating that there will be more interest rate hikes going forward. So that's what the market expectations are so far. And if it should diverge from this, we would see a reaction where if it is more hawkish than expected, then sterling will rise, interest rates will rise. But if it's the other way around, it's a slightly more dovish day. Likelihood they will be hiking, I think, given that given the data we've seen so far, but they could be moderate in their statements, which is very unlikely given that the data has been still disappointing them to the upside on the inflation front. But if you do that, then maybe the sterling will pull back from what current levels. Okay, moving on to trading tip of this week. We've all heard about, if you've gone to any economics classes or read any books on investing, they will always be talking about the importance of diversification, because they will say that, diversifying reduces your risk to a single asset and reduces the risk across your portfolio, and keeps your portfolio more resilient to one particular sector being affected by some specific news, and overall it minimizes risk. However, it may not be the great may not be as great as you think. Diversification is only useful if you really don't know what you're doing, because by diversifying, you're also spreading your capital across many different trades. It limits your potential upside, and diversification among different asset classes may work against you, because, for example, if you're investing in bonds, stocks, you're expected it to be having inverse relationships in performance in normal times. So when bonds rises, stocks go down, and vice versa. But in times of stress, in contagion risk, in times of stress, if it's seen, it's likely that they move in the same direction. And sometimes that is the case, especially what we have seen in recent months. In the past year, we've seen that in an interest rate hiking cycle, both stocks and bonds go down, and they go down quite aggressively. So we've been seeing we saw bear markets in both when the hiking cycle started. So you can only be using diversification. Diversify only if you know exactly what you're doing, and also if you do know exactly what you're doing, the need for diversification really is reduced. So what does that mean? It means that the primary aim of being invested is capital preservation as well as capital appreciation. And if you need to, at a baseline, you do not want to lose your capital, so you do need to not spread it across too many sectors such that you're getting the worst performance of all the sectors, right? So if you do have an edge, you know what you're doing, it is good to have concentrated risk in the sectors where you have an edge. So only invest in what you know, trade what you know rather than trade many different things because you want to have a diversified portfolio. So in the words of the best, arguably the best investor of our time, put all your eggs in one basket and watch it closely, right? This is the tip of the day, and hopefully that will help you in your trading journey. As always, stay true to the process and be disciplined and be true to the process, and eventually you'll build habits that will help you become more successful in your trading journey. Thank you for being with us. Take care and goodbye.